Ladies and gentlemen, the session will now begin. Please take your seats.
While not everyone would agree on the exact timing of the next recession, no one would deny that it would unfold in a volatile and uncertain environment. The world is coping with a global wave of populism, continuing political violence, accelerating trade war among the major powers, Brexit, and rising internal and external debt problems in developing and developed countries alike. Should the assumption of a stable and business-as-usual policy environment associated with business forecasts be challenged and changed? Given the recent macroeconomic management experience and a rising debt burden in the developing world, how will such a recession affect economic growth in low and middle-income countries? What are policy options and strategies for minimizing the adverse impact of recession in these countries?
Ladies and gentlemen, please welcome to the stage our moderator for this session, editor at Quartz Africa, Yinka Adegoke.
Hello, everyone. Thank you for coming to this panel discussion on the 10th anniversary this year of the global financial crisis. We have an excellent panel that's going to have we're going to discuss this topic. Let me just invite them on one at a time, just to just get us right into it. First, we have the Secretary of State in charge of Investment, Ministry of Industry, Trade and the Digital Economy for the Kingdom of Morocco, Othman El Ferdaous. Then we have the Minister for Finance from the government of Malta, Scicluna. We have the former Minister of Foreign Affairs for El Salvador, Mayu de Avila. We then have Otaviano Canuto. He's a senior fellow of the Policy Center for the New South, our hosts. And definitely not last but least, we have Professor Rym Ayadi of the Cass Business School in the UK. Thank you all for coming, and thanks to the audience for being here. This topic is one that is kind of in the air. I kind of remember where I was the first time around, so to speak, with the global financial crisis. And I remember speaking with I was a reporter at Reuters at the time, and I remember speaking to a Wall Street banker who kind of gave this kind of indication that something was in the air in 2007. It kind of, sort of said the markets are tight, and I kind of had no idea. And then I remember a few months later being in a newsroom of about 300 people, and the markets just collapsing, and all of us, this is a newsroom that was typically loud and boisterous, and everyone just like stunned into silence. And it's become one of the, in terms of economies and businesses where you have these discussions, it's become one of those where were you when it happened kind of things, and one of those key points in history, and everything seems to start all over again from there. So the reason we're having discussion is that the U.S. economy since 2009 has been on a tear, and has been expanding, and it's now on its second longest run, as you heard there. And by August, it could be the longest if the economy keeps on expanding. But there are lots of signs out there, lots of concerns. Interest rates are rising. Debt is also soaring. Debt is 217%, was 270% of GDP, global debt, at the end of 2017. And that's higher than it was at the end of 2007, just before the economic crisis. There was a survey of U.S. chief financial officers last month, and 50% of them said they expect a U.S. recession by the end of next year, by the end of 2019, and 80% of them expect it sometime mid-2020. So there are all these signs that that something is looming. And then we also have to think about the China-U.S. trade war, and even the Chinese economy is also slowing down. Where there are all these signs looming, and so I just want to sort of I think I want to start out with the minister from Morocco and just ask: have things changed, and this is just the new normal? Or is this just temporary? Are we just going through a temporary change right now, and this is the way we should view the economy, the global economy?
Yeah, thank you for having me. I'd say that one thing is sure, everyone's looking at the U.S. being the center of the pulse. There are a certain number of risks that could pose themselves. I'm talking about technological risk. So, for example, you could have some algorithm going wrong in stock markets. You could have cybersecurity risks, which are new to everyone. You have to learn how to cope with them. And let me say that maybe the event that will trigger the crisis, we won't talk about it today, because it will be a black swan, something that no one's seen.
We're not expecting. Right.
Yeah.
Right.
So you don't expect it. But my personal take on the matter would be that the next very big crisis would be pension crisis, retirement crisis, because we've seen the U.S. Let's take a look at the U.S. baby boomers. They were the single most important economic force in the global economy for the 50 years that passed. And they were buying stocks. They were buying stocks because we allowed them to, for the 401k plans were invented. And then they went on taking credit in the 80s because of deregulation. And the thing is, the event that's going on right now is the fact that baby boomers in the US have reached the average age of 64, 65, which is exactly the age of retirement. And this is happening this year, 2018. So if those guys, if this force, who was a buying force on the stock markets, becomes a selling force, we got ourselves a very big problem. And the latest studies that I read estimate that the pension deficit globally is about in the hundreds of trillions of dollars. So like the figure I read is $400 trillion. I'd say I'll take my Moroccan investment Secretary of State hat and say that this is an opportunity, because when you have a problem with financing retirement and pensions, there's an opportunity there. Why? Because if you have dynamic demographics in the whole world, but not in those countries like the US, the big economic zones of Japan, Europe, you're left with a few choices. You have aging populations who vote more and more for political actors that commit to sacralize the level of pensions. And those aged or senior voters, they're more disciplined. So it's a double acceleration. And if they vote for those guys, it means that you've seen in the last years, you have parametric reforms of pensions all over the world. We've touched every kind of parameter except the level of pensions. So if you're in this equation, the only two solutions you got are, first, migration. So you welcome migrants, like Germany did with the 2 million Syrian refugees. You welcome migrants, hoping that those migrants will work, integrate the workforce, and pay for your future retirement. The second solution would be robots. So you see Germany being a good example of those two first solutions, migration and robots, Industry 4.0, etc. And we've seen, interestingly, debates in Brussels where I think it was in the parliament in Strasbourg, and they were discussing the fact that robots should pay cotisation sociale. I don't know how to say it.
Taxes.
They want robots to pay cotisation sociale so that they can go to...
We've had Bill Gates discuss this.
Exactly.
Yeah.
So it's interesting that those ideas are floating in the air, because people understand that either you have migration, either you have robots. I personally have a third solution for this impossible equation, and that would be economic integration through investment with countries with a dynamic demographic profile, which can be done because when Japanese global players in manufacturing or automotive industry invest in Morocco, you know that the first private sector employer in Morocco is a Japanese company. It's Asahi AGC. It's an automotive manufacturing company. When they invest here, their returns, the higher returns they get from Morocco, are made to finance the retirement of older Japanese populations and older consumers in the world. So I think this third solution of economic integration through investment is a major solution that should be analyzed.
Okay, that's great. That's the Morocco pitch as part of that, part of the answer. Let me take the Europe perspective on this, Minister Scicluna. Are we in a new world? I mean, in this world in which we are now, Europe is like the old world, so to speak, especially when we think about, economies and countries that are older than than most of the modern countries today. Where are we now? Is this...
Vis-a-vis the topic, I mean, we're talking about a perfect storm. Yes. I mean, where millions lost their jobs, lost their homes, and their savings. So it's big. It's not something, a crisis or a regional. We're talking about an international one.
Right.
And the last one we remember from the books as students was the 1930s Great Depression. Mm-hmm. This one was big, very big, and it was quite painful, including in Europe. But we had learned a few lessons. In other words, it wasn't as bad as it was in the 30s. So it took a long time. It spilled over other crises, say, so from a financial to economic recession, mm-hmm. and in Europe especially, to a sovereign debt crisis. We still hangover of public debt. I mean, take Greece, the pain there, yes. Spain, Italy, you name it. So when you're talking about the future, now we're, at least from the banking side, we're much better prepared. We have a better financial architecture in place. Mm-hmm. The banks are more capitalized, more liquidity, and we've passed them through so many stress tests, which are more rigorous one after another. So when we look at whether it's looming or not, I think if we want, there are many reasons of concern. And the risks are, as the IMF said, on the downside. But to join them together and artificially say, if they were to hit each other, then you have a perfect storm. Yes, you can do that. But and it can happen. But I think it's more remote. From the EU, it's more that we haven't finished our job. There was the banking union, and we're still playing, whether about risk deepening or risk sharing, and a lot of brinkmanship, mm-hmm. and Brexit on top, and Italy on the other. So no, there are many things of concern, definitely. But to join them all together and other pressures around the world with China and all that, I think they don't bode well for the future. But I wouldn't go as far as say, look, it's looming, and we're in for another big one like we had. So
you seem to be saying these factors.
There could be a mini crisis. I mean, some economists say we might need them, instead of waiting, and then you have a big bang. Right. It's better to have a certain mini crisis, so at least you start saying, okay, let me prepare for this, and serve as a warning, and to show your vulnerabilities. There's no harm in saying, look, I mean, your risks are on the downside, and if you don't do this, then this would happen. I think that's quite healthy to have, but to sort of to join all the threads together and say, look, here we go again. Mm. I think that we're taking it a bit too far.
Okay, let me ask this to Mayuna in a slightly different way. I do agree with what you're saying there, Minister, but isn't debt really the underlying issue here? Just the amount of debt that is not just, across the world, particularly in emerging markets, which is 50% higher on average than in, sort of the wealthier nations. Isn't that kind of the underlying issue here that kind of pulls all these things together?
Yes, Yinka, and allow me first to thank the Center for the New South for having invited me to come over. I come from El Salvador in Central America. We're blessed to have coasts both on the Pacific Ocean and also on the Atlantic. So I'm excited about the Atlantic dialogues because of that, and to encourage even more reciprocity between our two continents, and that we not only speak of a Northern Atlantic, but also of a Southern Atlantic. And as coming from Central America, first I would like to answer your point I would like you to really understand that when the United States sneezes, we catch a very strong cold. So for us, monitoring what is happening in the U.S. is extremely important. And right now, you have the Fed that has contained the increase in the interest rates because definitely right now the U.S. is performing well. If you look at, for example, the second quarter in 2018, GDP rose 4.1%. That is the strongest that they have ever had since 2014. So what is worrisome? What's worrisome is that expansions cannot go on forever. And so what you have to start looking at are those hot spots. And Yinka, you touched exactly on one of them. And one of them is debt. The figures that I bring to you here are not so global. Again, I want you to understand how much the U.S. impact can be, not only in my little Central America, but truly on the world as such. So there are three hot spots we have to look at. Borrowing, as you correctly stated, Yinka, housing, and unemployment. Debt. Let's look at first the corporate debt. Historically, peaks in corporate debts in the U.S. have always been followed by crisis, by recession, always. And if you look at the first quarter of 2018, the total debt held by U.S. companies was $29.6 trillion. That is the highest ever figure we have ever had. But what happens is that debt at this moment has been almost free because the rates have been kept so low, they're almost zero, so it hasn't had much of a cost for the companies. So what is the risk? Even though companies have invested in research, have consolidated, have bought stock, they're a bit more solid. The problem is if that interest rates, as they are starting to hike, as you correctly also stated, Yinka, will make that debt more expensive. And it's not only the amount of the debt and the possibility to pay back is what worries me, it's the quality of the debt. Citibank issued a note that in 2017, $1.6 trillion of that new debt given to companies was given to borrowers with less than stellar ratings. What does that mean? That if the interest rates continue to hike, if we go into some trouble, they will definitely have a very hard time paying back. So it's not only the quantity, it's also the quality. So if we go then to the second one, which is housing, you remember last crisis was all around mortgages. But we learned a lot, and Minister also stated quite well in the sense that U.S. banks, as world banks now, are much more solid and they have much more capital, and the system is better off. But there's one worrying indicator that we're looking at, is that the average debt to income ratio for mortgages, according to the Federal Housing Administration, which holds almost a quarter of all debts in the U.S. for housing, is the highest level ever. What does that mean? What that means is that because there's a limited inventory of housing, the prices of houses are higher and the wages are low. So your relation of income to debt is tightening. That it puts you on a very vulnerable situation. So yes, owning a house is much better than renting it and spending almost all of your income into paying rent. But the problem is then, if you see and you look at the possibility of, first, a dramatic rise in the cash-out refinances. What does that mean? There's an innovation within the U.S. market in which when you have a mortgage, then you can use your house as an ATM. Every time the price of the house rises, you just go in and get more money. So then it's putting even more stress into that income ratio. And the other one is that there had been a proliferation of down payment assistance programs, so people who maybe could not have gotten that house or that down payment did get it with that assistance. And the last one, if you allow me to insist, that is again around debt, is the debt that we are getting also from student loans, for example. There is in the United States $1.5 trillion in what is student debt, of which 20% is already delinquent. So you can say, yes, that money was given by the US government. It will not poison the banking system. But what happens is that you would then have a whole generation of millennials wiped out because they would not have any acquisition power. And the last one, unemployment. Yes, we have the lowest unemployment in the United States in the last 50 years, 3.7%. It's fantastic. People who would not get hired are being hired. We have people with disabilities, people with criminal records, people that are getting engaged. That is fabulous. But what has historically happened when that level, which economists call the natural rate of employment, it goes too low? That's when people feel secure to change jobs. So then they start changing jobs, what means that companies start competing for the best talent, start paying higher wages, start raising debt, and that brings inflation. So historically, you've seen the Fed come in and try to retrain that mismatch by hiking interest rates. So it's a perfect storm, as you said, a possibility, but I just gave you 3 examples of three concrete hotspots that we're watching over in the US, as we don't want to get a heavy cold.
Thank you very much for that. It was kind of weird. As I looked at you, all I could see was that big debt sign behind. To be honest,
yes.
I kept on feeling it was swinging towards me. I think it's a good time, because before I come on to the next question with Otaviano, I wanted to use the word cloud and just get a sense, because we have I think there are people from about 80 different countries in this at this event, and I wanted to get a sense from how people are thinking about this and where they think the impact of a global recession, even if it's not a great recession, but even a really bad economic slowdown, what regions in the world we would see the most impact. And I guess you could, I think the trick was just to have one word, either a country or a continent or a region that you, the audience, people you use your app, feel will see the worst impact in the coming year, probably 2 years. I guess we're thinking about it starting now. Okay. Africa is in the lead. It's not the kind of lead we want, but there you go. The BRICS. Somewhere between America. This is very even. Oh, you can see it up there. So far, I feel like it's just the world. Yeah. BRICS are coming out front. Where are we? 16 seconds to go. Africa still leading. Countdown, nearly done. Okay. Why does mine have to be so difficult? Everybody else had a very clear winner. I can't tell who wins it. I think it does look like it's somewhere between Africa, the BRIC nations, and the United States.
It just shows you how interconnected we are.
Yeah, exactly. I mean, or it could just reflect the mix of people in the room who are just all very skeptical about, the sort of the situation, the issues that has been laid out so far. So, Otaviano, let me come on to you and I just want to come back to that point about whether things have changed or this is a new normal, how we think about dealing with the situation we're in right now, or the situation that's coming.
Right. Good. Thanks for having me here as well. I guess several ingredients important to our discussion have been laid out by my three previous speakers. One, to start with, we are not in Kansas anymore. This is no 2008. And inevitably, as aptly said by the Minister, this doesn't mean that we're not bound to suffer shocks, and I will illustrate some of them. But it doesn't mean that we could have a repeat of 2008 and 2007, in fact. The crisis started 1 year before Lehman Brothers collapse. And the reason is that one major responsible actor for the ripple effects through the system is no longer there, banks, including particularly European banks. To some extent, what happened to Portugal, Greece, Spain, was a mirror image of what happened in the action of European banks in the US. Although many people put the blame on Chinese savings over buying assets in the US, work done by the guy who's now the chief economist of the BIS showed clearly that the major bubble maker was the layer of European banks taking money in the short-term money markets in the US and buying immediately long-term toxic assets. And this didn't call much attention because although the money never left out the US, in terms of a balance of payments, the short-term outflows were netted by the immediate long-term inflows in the US. The European banks and some major US banks. And this is what made the collapse of bubbles in the US and the collapse of the bubbles in Europe a systemic issue. Since then, we have watched a sort of a metamorphosis in the financial system, which has led to new sorts of fragilities, and some of them have been referred to, but which have different systemic impacts. Banks have retrenched, have tried to clean their balance sheets. They have succeeded to a large extent, in Europe to some extent, in some places not. But whereas the extremely favorable liquidity conditions led to the rise up of the non-banking financial intermediation, as aptly described by Minister. And now what you're watching is exposure. And if you pick up the chapter of the book co-written by me and Ag there, we show the aggregate data. Well, it smells trouble. Right. But when we look at it more closely, then you have to understand that you cannot be expecting a sort of a miskin moment in which we are bound to explode. And I will try to say this. First, the growth of the global economy is already moving down. The leading indicators are pointing this out quite clearly. I can bet with any one of you here that the forecasts from the IMF and the World Bank will come in January, lowering down the prospect for next year. Among other reasons, because the growth of the U.S. economy this year has been completely extraordinary. It was due to the corporate tax cut, the macroeconomically, some say, even irresponsible fiscal policy adopted by Mr. Trump by taking fiscal stimulus at the moment at which the economy is already at full employment. So this will not be there next year. Secondly, the normalization of monetary policy is already showing up in the shrinking of central banks' balance sheets.
Yeah, tighter.
Question is how smooth and easy the U.S. goes on this, but this is already starting to tighten up. Thirdly, one of the expressions of the excess liquidity of the last decade is showing up in the valuation of the stock markets in the U.S., which has been in a course completely out of line with fundamentals, any fundamental you may choose, price the price ratios of shares vis-a-vis profits and so on. And what we have been watching since October, it is exactly a downward adjustment of those stock market price. And there are some who are even predicting still 50% of adjustment as something in the range of 35 to 50%. So this is all, these are all manifestations of how far we went with the liquidity providing at the same time a cushion against low growth, but also creating disequilibrium. Will that generate a crisis? Nobody knows, in the sense that it is not as obvious as it was the case when you had banks at the center of the process. In our chapter, we propose to approach this issue with buckets of countries. And because otherwise we tend to be mixed up by simply look at the aggregate debt. It really surprised me that China went so little in that chart. You talk about emerging market corporate debt issue, most of it is China. Does that mean that China is on the verge of a crisis? No. Because China has a peculiar balance sheet condition that I'm not saying that it's straightforward, but conceivably, if the central government decides to do some sort of large encompassing bailout, it has the means for that, including foreign reserves that can cushion from any capital flow. So when you take out China from the corporate debt of emerging markets, the picture is completely different. Don't be confounded by what happened to Argentina and Turkey, because that was a special case of vulnerability to dollar appreciation. Okay. So if I would say that the place to look at when it comes to will we deep down in our growth in the next few years, will we be facing some sort of financial crisis, I would say look particularly to what happens to China. China, Professor Valadão has used the example of moving on two paths. At this moment, China is crossing the river, stepping on two stones, to use the Confucius analogy, but the problem that these are floating stones. On the one hand, it is implementing a deleveraging process, submitting everyone who benefits from the loose monetary policies and infrastructure investments after the global financial crisis to a grip, responding to the signals that everybody said, well, you better watch out with the rise of your debt. But on the other, it cannot do this to the point that it might jeopardize keeping growth minimally strong while China is rebalancing. This has been said here today, it is right. China is moving towards a lower growth rate, and it's okay because it's going to be more based on consumption, on rising purchasing power of the population. But the question is that how low will that be the new Chinese normal? It's different if it's 6% or if it's 3% or 2%. And that's where we are watching the full contradiction. As I would be concerned mostly if we're talking about crisis, because of the impact, because of the weight that China's growth has had in most of the world, particularly emerging markets, in my region, in our region, and in Africa, it's China. This doesn't mean, of course, that, for instance, Africa may not be affected. But obviously, a financial crisis of the currently indebted, natural resource dependent African countries will be terrible and tough for them, but not for the world economy. So let's keep things in perspective.
Thank you very much for that, Professor Ayadi. How do you, I mean, just to get, again, come to tag on to that with reference to emerging markets, in particular lower middle income countries, how do you see, and we saw the cloud there, the countries, the regions people thought would be affected. How do you see it in terms of that part of the world, those countries, low and middle income countries, how they'll be affected by a global recession or a global slowdown, particularly starting at the US?
First of all, thank you very much for inviting me for this event. Now, obviously what we heard is if we go back since the 2008 Great Financial Crisis, it is clear that a lot has happened from the developed nations to deal with this accumulation of risks that have been accumulating over decades. And then they erupted in 2007 to 2008. And this is actually, it was clear that some of the risks they haven't been even known or managed properly. So first of all, let us understand one thing. If economic crisis and financial crisis will always happen because the risks are not always determined and identified correctly, and there is accumulation sometimes of unknown over the period until there is a eruption, either local or regional or global. Now, obviously, the weight of certain countries, they have an impact, more impact than other weights of other countries, which are very small. And I completely agree with my colleague here that some small countries might suffer less or might suffer more based on their percentage in the world economy. Now, obviously, at a local level, if we talk some countries in Africa or Middle East or other region of the world, the determinants of economic crisis might not be the same. So there are macroeconomic factors. Of course, if there is a global crisis, they will suffer because there is less investment, less financing. Most probably the risks are completely repriced. When the risks are repriced, they might win, they might lose. In the case, for example, of the economic crisis in the developed nations, we've seen clearly that a very low interest rate has benefited some countries in Africa, while the risk has been completely repriced, and they got much more money than anticipated because many countries, many investors wanted to have a much higher risk and then much higher premium, in fact, a much higher return on the investment they made. So then the whole risk factors have been repriced. And I think this is also something to keep in mind. So in reality, if we look at the, I want to go back to the determinants of the local economic crisis, like, for example, we take the case of Tunisia, which, in fact, the economic crisis is coming from idiosyncratic factors of the difficulty to implement some political transition. These are more political factors that have been very much impacting the economic crisis within the country. Now, this is more or less also linked to their idiosyncratic factors and how they're managing their economic policies inside the country. Now, if we link this to, for example, a protracted economic crisis in Europe, and this happened also, it is clear that the terms of trade have changed dramatically. The investment, the foreign direct investment has decreased as well, and this had implication on countries which were very much linked to specific or concentrated countries which have been living this economic crisis. Now, that is why it's extremely important to think of different dimensions, especially in terms, for example, of the diversification of the partnerships. So then if there is call it an economic crisis in Europe or in others, then they have other possibilities to continue and deal with the crisis and deal with the risks within those crises. And again, I go back to my point to say that it's extremely important to identify risks and then manage them timely. And this is what I think these countries have to learn over time.
Are you seeing any countries in those low and middle income countries that have policies that are able to manage this?
Yes, that's a very important question. In fact, the majority of the countries are helped to a certain extent by international organizations like the International Monetary Fund. And then those countries have been very much under these type of programs to ensure that they are managing their debt level, not only, especially on the public side, and also to ensure that the budgets are what we call the budget sustainability and debt sustainability over time. And up to today, they might have improved a lot, some of these countries. But to give or to nail down one country that has really performed quite well, it depends on the period and it depends how they do it. And again, they have to enforce what I call difficult policies. But then when they enforce difficult policies, like for example in the case of Egypt or in the case of Tunisia or in other cases as well, or even in some African countries, then you have the social tensions because when you lift some subsidies, then of course the prices will increase and then this will have implications on the population itself. And this is what is happening, in fact, in several countries, especially within the financial crisis, so within the economic crisis over time. We need to think about these social tensions as well, and there are some trade-offs that need to be looked at very, very carefully.
Yeah, this is clearly an issue in Africa, particularly sub-Saharan Africa. We've had several, we've had several pieces about this, looking at what some have called a ticking time bomb, because lots of countries have gone out and, raised a ton of debt on Eurobonds, which seems to be the trend of the day. And if, as you laid out there, Maya, the interest rates start to tick up and consumer economy starts to slow down, you could just see somehow us getting back to 30, 40 years ago, where countries couldn't actually pay back. Let me come to Morocco specifically in terms of, the economy has kind of been slowing down, and you sort of on the debt level seem to be managing. But what's the sort of outlook for Morocco for you?
I'd like first to just pick up one point that was made. I'm not an economist, so being a decision maker, I can only see that there's a crisis in economic science and how all the solutions, the economic solutions that economic science brings to decision makers. And I'd say that facing those kind of uncertainties, I cannot trust economists. This is why my first intervention was about demographics, because a demograph is a predictable science. The other kind of predictable science would be technology. So I cannot say where the stock market or inflation rate will be, but I can say roughly where technology is going. And I'd like just to pinpoint one single piece of technology that could change everything, but nobody talks about it. The artificial intelligence when it comes to natural language processing. So if in the 5 to 7 to 8 years to come, there's a new way of systematic translation, instant systematic translation technology that breaks through the market, that means that you have instantly 4 billion people joining the global market. It could even usher a new era, a new wave of globalization. So our discussion today about crisis will seem like a prehistoric discussion. So there are black swans, but there are also white swans, I'd say. The other thing I'd like to say is, you talked about Morocco. Morocco was on a trend, 10-year growth trend of 4.7 growth average. After the crisis, we lost 1 point. We're 3.5 growth average since 2008. But the crisis didn't didn't impact Morocco in 2007, neither in 2008. It took 2 years to impact the Moroccan economy. So this is, you can call it resilience. You can also call it not being so integrated in the global economy. So it depends how you want, at what level you want to read it. But I'd say that Morocco is taking steps to improve that resilience. So, for example, the flexibility for the Moroccan dirham on the monetary market. This is important because it gives you assurance that, you know, we always say Morocco is a stable country, stable country, stable country. I don't like the word stable because stable means you pretend you never fall. Whereas resiliency means you can fall, but you get up again. And that's exactly what we try to do in Morocco.
Okay, let me see if we have questions from the audience.
May I?
Oh, yes,
May
please.
I jump in?
Go on, May.
Because, I really enjoyed also
I'll take
your
that.
comments in the sense that I'm neither an economist also, but I do worry of the effect and impact in my countries and in Latin America. What is it that we fear? It's populism.
Yeah.
The rise of populism. Why? Because decision makers then can't make the right decisions, taking advice from whomever it is. So, for example, what did we learn in the last crisis? The last crisis, first we had Basel III, which strengthened banks, the regulation, and the dynamics by which now those risks are more visible, you know, to take away the invisibility of those risks. Then also, we had better coordination, and we had people like Bernanke, who was the president, the chair, of the Fed, who could take technical actions because he had 30 years experience in crisis. So he could act immediately together with the Treasury. But what happens when you don't have that luck of having a good team, a good technical team, and a good response, and you are bound by populism? What would be the metric to take then action within either a crisis that is in full blown or just starting or a micro crisis?
Right.
Because then the parameters are more subjective, maybe more guarding interests instead of national visions. So that is my worst fear. Thank you.
Let me come to
when you talk about crisis, one should really concentrate on trends, worrying trends, and sort of unstoppable trends which will have negative effects. And even though I'm an economist, normally it's economic and financial indicators. In this case, the worrying trend is political. And the lack of trust in leaders and the civil society structures in many countries. And we always try to rationalize them because it's the US, it's maybe because Trump didn't get all the votes, because of this and because of that. Then you go to Brexit and we say, it's the old people who voted because of this and that. Yeah. And then you go to France and say, but this. And then it's Italy. And then you're spreading. And then you go to Austria. And then you Sweden, you know? And so, wow, it's and what is it leading to? Bad economic decisions, losing the independence of the central banks, especially where there are authoritarian regimes. We're seeing it in many places. And reversing or deregulation. And a goodbye to structural reforms because they are not popular automatically. And this is the worrying trend.
So the end of pragmatism.
It looks like at the moment it's unstoppable. Yeah. So if you're looking at trends, I think we should look at that, and then it will impinge on trade, and then and spreading to bad economic policy making.
Otaviano, then we go to the gentleman.
That I'd like to make, taking the chance on examples of countries that followed policies that diminished vulnerabilities. Go to 2013, when then Fed chairman Ben Bernanke alluded to in April of 2013 that the Fed would start thinking about unwinding the unconventional monetary policy. That generated a crisis, at least an immediate pressure on the balance of payments of the so-called five fragile countries. Turkey, Brazil, India, Indonesia, and South Africa. Now move forward and go to 2018. What those fragile five countries had. balance of payments, current account debt, close to 5% of GDP. Well, in 5 years, among other reasons, because some of those countries floated their currencies and allowed for some adjustment on the current account. Then in 2008, only Turkey of the 5 was there, and one additional had joined that group, Argentina. And that's why the upheaval on emerging markets of this year was solely focused on Argentina and Turkey. By the way, Argentina has done some effort exactly to get that. So this is a sheer example of how right policies matter in terms of coping with the risks. And Deputy Minister, you may not be an economist, but your emphasis on demographics, your intuition put you to a very important aspect. Now, I will say in one sentence, demographics is already starting to change the wave of demand from pension funds, financial markets. The rate of disbursement, and because of the life cycle of savers, is starting to move, the needle is starting to be moved. So to make things even worse, pension funds have found high difficulty to get rates of return compatible with their fiduciary responsibilities. Among other reasons, because they do not come and finance risky investments in developing countries and so on. So demographic is at the core, if not of the crisis in 2019 or 2020, but it's a concerning long-term trend that is a ticking bomb.
Okay, so we're running out of time. The gentleman's been waiting for quite a while. Thank you.
Yeah, Louis Dadouche with Policy Center for the New South. If I may, I just want to make a short comment.
Okay.
Yeah, so I was in forecasting for 30 years in the private sector and then at the World Bank, and I made many mistakes. And so I just want to recognize the decision makers. I made many mistakes.
All the Africans in the room.
Many mistakes. I learned two things, if I can. You know, at some point in life, you want to share a little bit. Two things I learned. Number one, you cannot forecast a financial crisis. And the reason is very simple. Because if it was easy to forecast a financial crisis, very probably it wouldn't happen because people would adjust. Okay? Yeah. So until somebody disproves that simple hypothesis, I assume that you will not forecast the next financial crisis. It will come in a way that is very difficult to tell. The second point I learned is there are many crises, many types of crises. The sovereign debt crisis. But most of these crises are relatively small crises. The big crises come from one thing: banks. Banks. And the reason again is because a bank can be borrowing 50 times its capital, or it can be borrowing even now with the capital requirements 10 times its capital. If you're borrowing 10 times your capital, you know, and lending 10 times your capital, basically any kind of shock, any loss of confidence will take you downstream. And I connected to my first point. It's why it's so difficult to predict, because confidence is playing a key role. I always laugh when I read the stress tests from these wonderful central bankers that are telling me, it's okay, don't worry about it. We've checked. I do worry about it, because even 10 to 1, a change in confidence will take you down, and then it becomes generalized. So bottom line is, you cannot anticipate the financial crisis, but at least watch the banks.
Okay, thank you. Do you want to? And then I will see if I can get one more question in before we have to run.
What you say?
Only told us beforehand.
Go on.
Just one quick idea. What is possible is to put some science in the decision making. So there's an example from Latin America, Chile, which is specific, but it's good to remember that Chile has set up a scientific committee to determine each year the 10-year equilibrium of copper price, which is a big factor for Chilean budget. And so they've taken this decision-making from politics, because if you wait for the crisis to begin, politicians will begin fighting about is it the time to put forward a counter-cyclical policy or not, depending on their interests and the electoral cycle. So Chile is a good example of putting some science into this economic nonsense.
Although commodity price forecasts are also liable to suffer from the same kind of a problem.
Go on.
Can I answer I mean, just give some element of answers. It also depends on how big the banking sector in each of the countries. See, if we look at the Eurozone, for example, we reached a level of 50% of GDP. So it means that not only when these banks entered into the financial crisis, they were very low capitalized and very highly leveraged. So they were not resilient enough to resist the financial crisis. And this is what exactly happened in Europe. So again, to be able to manage the next economic or financial crisis, you need to build your resilience. So how to build your resilience? In my view, forecasting models, economic models, they might not work because the underlying factors are changing over time. They're very uncertain. And this is not only about idiosyncratic factors that everybody most probably can predict, but then macroeconomic and geopolitical and political factors that might not be predictable easily, and the interaction of them over time, it's something completely different that nobody knows about.
I think that seems to be a common theme throughout, right here and from the other panels as well.
That's the point. So just I want to land onto my point is that at the end what we need to do is just to understand this and use foresight instead of forecast. So what's the difference, in fact? The foresight allows you to build certain scenarios based on certain interaction of those dimensions of risk that allows us to understand what are the intervals of actions that we could do as policymakers to adapt the economic policies and the financial policies in a dynamic manner. And this is something that could be most probably some recipes for the future for developed countries, but also most probably we need to think about other factors, the role of institutions and some other things in the less developed countries. And this is what is for me very key to determine the success of how countries can go and resist into the next financial or economic crisis going forward.
Okay, thank you. Let me. This gentleman here has been waiting for a while. Any other questions? One more.
Thank you. I'm Eric from the DRC. One of the common mistakes that has happened over time when you look at financial crises is that we always try to shield from the next crisis, looking at the past ones. Today, banks are important variable to look at because the last crisis emerged from banks. But the next one might be totally astray from the mainstream of crises that are banks induced. When you look at the level of lending by non-banking actors, which is sometimes called shadow banking, it has substantially risen. And those non-banking lenders are less regulated than banks were in 2007. So imagine what could happen. You must also look at new risks. You have a growing intermediation, financial intermediation, that is not done by banks anymore. You've got fintechs that are rising, which are not really regulated. You also have the impact that might come from blockchain and technological breakthrough. So if we only look at classic actors, we might not be ready for the crisis that might be looming.
Thank you. The gentleman there on the point.
To be brief, My name is Juliana. I'm from Argentina. Jumping on what you said about populism and the policies in Argentina, my question is, what is the way out in this struggle between populist policies, spending a lot of money, specifically in social policies, and then more liberal governments coming out and doing the right policies, but borrowing a lot of money, in the case of Argentina, almost $100 billion in 3 years, with interests that have to be paid in the next 100 years. So what is the way out in this
I'm going to
struggle?
get Mary to take that afterwards, but get one more in. There's a gentleman over there. Thank you.
Thank you. My name is Plamen Toncho from the Institute for International Economic Relations in Athens, Greece. A question for Mr. Dos Santos Filho, if I'm pronouncing your name correctly. I wonder whether the IMF has learned some useful lessons from its involvement in the Eurozone crisis. And I'm asking this because I understand that a number of IMF members, such as India, Brazil, possibly Indonesia and South Africa, had a lot of objections. Their argument being that why should we help out Europeans when there are so many other pressing needs in other parts of the world? I wonder whether you could comment on this without possibly spilling the beans on some confidential internal discussions. And another question, which is related again to Mr. Scicluna, if I'm pronouncing your name correctly, since you come from the Eurozone. The EU has come a long way with the ESM, the European Stability Mechanism now. I wonder whether that's bound to turn into a European Monetary Fund, and if so, when that's likely to happen. Thank you.
Okay, Maya, you want to go first on Argentina?
Yes, I'd be delighted. Bienvenido, colega. Again, thank you so much for being here. I'm so pleased every time that I see that the Policy Center has made it a point of inviting people from every corner of the world. So Argentina present here also. Unfortunately, there is no silver bullet solution. And that is part of the problem with populism, because then you get messiahs who rise in these countries offering that they have that solution. And that the only way out truly is through building that resilience that we were speaking about. And that means we have to many times do many sacrifices. The difficult part is that our populations, the majority living under the line of poverty, cannot take it anymore. And so there has to be a very conscious of the different stages in which we will be endorsing, or should as a country, build that resilience in following some type of route that will always be caring humanitarian, because there will be a lashback against the most vulnerable. For example, there could be, in my country, in El Salvador, our debt is 70%. So the possibility of doing more populist programs for to remain in power is backlashing for the government, and we're having presidential elections next year, and their own people are voting against them. And so, but there is no other way but to take that pill at that moment. So we believe that this politically is to take the opportunities to cement hard stabilization and to protect the most vulnerable.
Okay.
Great. Can I comment on Argentina as well? Because, the problem in the case of Argentina has more to do now, or it's improving the shape, not with the wrong policies. On the contrary, it was the pace of correction, which was too slow. President Macri started doing the right thing. But given the legacy, the size of the legacy from the bad policies of the present government, and forgive me if I'm you are not a supporter or anything like this, but the point is that Macri has been doing the right thing. But then at a certain moment, particularly the end of 2017, decided to slow down even more the pace of adjustment. And that's what took Argentina into 2018 in a vulnerable condition, in a moment at which there was this spike of adjustment. So Argentina has been doing the right thing, but not fast enough to be free of being paired with Turkey. On Europe and the IMF, It's so good to be retired. So I'll tell this story. At least for those of you who are here, to understand exactly the responsibilities and avoid falling into this trap of putting the blame on the IMF. I was there. I was a member of the board of the executive director of the IMF during this process. The IMF board wanted the IMF to pull out in between the first and second package if there was no debt restructuring. The ones who pulled the IMF to use the power to keep the IMF in without debt restructuring were them. The others, Germany, France, and the US accepted. But this came with the strong fight at the board of the World Bank, to the point that in between the second and the third, the board approves the resolution that the IMF will not provide any more money to Greece if there was no debt restructuring process. And now, one different from the others, which helped the French and German banks to pull out, but now there will have to be some sort of debt restructuring accepted by Germany. The Germans have another approach. They don't want to reduce the debt before they see as a real commitment for structural reforms and so on. So give the responsibilities. Of course, the IMF, I grew up listening to the IMF as the scapegoat, the bad guy. But in this case, I'm a testimonial witness that it was not the IMF as an institution.
Could I?
Of course.
No, I cannot agree more. I was there, and it was Germany's idea in the first place. I think, as far as Greece and Ireland and so on is concerned, I think Europe has the resources to do it alone. I think bringing the IMF in, especially for Germany, was because Europe is a giant with feet of clay when it comes to the politics. It's very difficult. So with getting an external, it thought that it would be more rigorous and so on and so forth. However, it did complicate matters with Cyprus, and then also with Greece. We had sometimes two or three versions of the remedies, one coming from the ECB, then the Commission, and the IMF. So it did complicate, especially it was very embarrassing when the last phase for Greece was concerned, where we didn't want a haircut, and the IMF was insisting on one. So, whether it was, and on the other hand, of course, the other countries would say, look, I mean, all the attention to Europe, I mean, you're giving its undue attention. So I can confirm.
One thing that I also need, the fact that the next crisis will come from unknowns.
Yeah, I wanted to come to that, actually.
Does not take relevance of coping with the risks that are known and they show up. So therefore, the relevance of policies catering to risks. And by the way, again, to give one more word to our Deputy Minister, if there is a lesson that macroeconomists have had from the global financial crisis, is to be humble with respect to the interactions between the real economy and finance. There are inner flaws in the way by which macroeconomists have dealt with the finance. And guess what? Even today, we have not solved the issue. So we have to play with simulations with foresights rather than forecasts, because the interactions between macroeconomics and finance give way to multiple interactions that no one can claim to be, economists cannot be as arrogant as they were at a certain time.
Professor?
On Europe, perhaps Europe need to agree on burden sharing, first of all. And two, to continue the build-up of the banking union, of its third pillar, which is European deposit insurance. This is key, in fact, to be able to most probably think to have this EMF or whatever. Many economists, okay, let's not talk about economists, many analysts have been pushing for over the last years. But then again, key is burden sharing at EU level, especially at Eurozone level, and how to deal with the other countries. So these are matters that need to be looked at very carefully.
Do we have we have time for maybe one last question. Is there anyone on this section of the room? Because I couldn't see anyone. Okay, this gentleman here, I asked earlier. It will be our last question.
Well, from the Jamaican mission to the UN in New York, and I appreciate the former foreign minister of El Salvador's perspective with respect to the importance of the United States as being at the center of the global economy and how susceptible we all are to spillover effects. And obviously, if there is a crisis or a recession in the United States, well, it impacts us because most of us export to the United States. So depressed demand in our major export market obviously has a serious effect on our economies. But with respect to the winding down of the unconventional monetary policies, the tapering that you mentioned, sir, obviously for those that have high dollar-denominated debt, it's going to have an immediate impact on us because we'll be paying more in terms of interest rates.
Exactly.
But I would also be interested in hearing your perspectives of another implication of rising interest rates in the United States, which is reversal of capital flows from emerging market economies and developing countries, because investors would be chasing yield in the developed countries, and so there would be an outflow of capital from our countries. And if you could indulge me, I would just make one other comment, because there was a point made about the centrality of the banking sector with respect to some of these crises. And I think the banking sector globally is much more resilient than it used to be. A lot of that goes down to the regulations that have come in place from Basel III, the sort of tier one loss-absorbing capital that make them much more resilient now to withstand the future crisis, this sort of liquidity buffers. The difficulty we have, though, is that as developing countries, we are trying to raise enough money in order to implement the Sustainable Development Goals. And the fact that you have this sort of tier one capital being held by banks is exactly the opposite to what you really want to do, because they don't want to put their money into the sort of long-term value-creating, sustainable investments that we need to see. And so they want to put the money into the short-term investments. And so there seems to be some sort of discontinuity in terms of policy, and I'd like to hear some comments on that as well. Thank you.
I'd certainly like to hear comments from you, Professor, on the reversal of capital flows. I think we probably only have time for like one quick answer about that being part of the looming issue coming. Reversal of capital flows, which you talked about as investors move their cash away from countries which had higher interest rates previously.
So I didn't.
The adjustment to the unwinding of commission.
Oh, yes, sorry. Yeah, okay, so this for sure will have risks on many countries. Because you see, when you have lax monetary policy, then you have cheap cash. And this will have even implication, a large implication on certain business models of banks. And again, I want to go back to the centrality of banking, especially in countries that they have a large banking sector, but at the same time you need to have a large banking sector to ensure that your economy is functioning. But you need to have a banking sector that is well regulated. And I emphasize the positive impact of the banking regulatory new approach of Basel and looking at the asset and liabilities. But again, having an increase in interest rate, and if banks are not readjusting very quickly the liability side, especially the ones that are getting funding from the market, then there will be extreme shock there on them, and they will have implication on the asset side of those banks over time. So that is why it's extremely important, as soon as there is an increase of interest rate on the liability side of banks, because they are borrowing, or they're getting from interbank market, then they need to think very carefully and change their business models to get more deposited rather than market funding. So, and then I want to go back to your point on the new risks on fintech. Now, again, banks are very special because they are regulated and there is deposit insurance. So there is always a possibility for contagion when depositors are going to pull out the money. This is what happened in Northern Rock, for example, in the UK. But then when you talk about peer-to-peer lending and, say, fintech, it's a different type of risk because it's much more on the asset side. Maybe there will be bankruptcies and so on and so forth. But again, there is no this deposit insurance yet. So it might happen one day, but nowadays you don't have it. So it's completely different type of risks.
In Africa, we have very few deposit insurance.
Yes, I know that. But the banking sector in Africa very small and they are not functioning. So that's important.
Okay. May I say just one thing? I will be finished to the point. If you look at the unwinding of non-conventional monetary policies, has been the most foretold story of the last decade. I wrote about it in 2011, how it would come. And since 2013, if you look at the data covered by the Institute for International Finance, look at the evolution of corporate debt of non-emerging markets, and you take out China, that's why I insisted, treat China apart. China is a story in itself, for good or bad. But the fact is that there has been some adjustment, some slowdown in the appetite on most emerging markets. And that's why the first real signal of change of risk premium last year did not lead to any sort of downgrade of all emerging markets. So the direction is the one that you said, but not necessarily a systemic crisis as it was thought of some years ago.
Okay, I unfortunately I have to wrap this up. This has been a fascinating conversation. I really implore you to join me in thanking an excellent panel. Really, really interesting. Thank you very much.
Ladies and gentlemen, may I have one moment of your time for an important announcement? We will now be leaving for your assigned breakout dinners. For those with dinners outside of the hotel, transport will be leaving in a few minutes. Transport will be leaving in a few minutes. Please follow your host's directions outside in the hallway and make sure that you are on time. Thank you very much and enjoy your meals.